Thank you, Dr. Bernanke. I want to talk about a different topic here today, a somewhat esoteric topic that may not be of interest to a lot of folks, but it's something that caught my attention. I want to talk a little bit about the interest rate derivative market, and specifically the market for interest rate swaps. Apparently, if I've got my numbers correctly, the notional size, the notional value of the size of this market has grown from $682 billion in 1987 to over $400 trillion today, roughly 6 size of the world economy. And I recognize that's notional value, but it certainly implies a large underlying gross market value to this particular market. And there was a Federal Reserve of New York report back in March called an analysis of OTC interest rate derivative transactions that essentially said that this market was very difficult to measure, very difficult to see, very difficult to value. It said that most of the transactions occurred over the counter and not in the broader exchanges. And the actually said that the lack of comprehensive transaction data has been a barrier to understanding how the OTC derivatives markets operate. And as I was reading this, it struck me that a lot of those words could be used to describe what happened with the mortgage-backed securities and the collateralized debt obligations issues that we had back in 2008. So I guess my first question is, should we be concerned about this market and its lack of transparency?
Well, it's probably one of the most important derivatives markets, and we pay a lot of attention to it, as do the SEC and the CFTC, who have a lot of the jurisdiction over those swaps. I think it's important to say first, on the one hand, that those numbers that you cite greatly overstate the actual exposures that the people involved in the swap are facing. Those are just notional values. It's also true that interest rate swaps are typically among the most straightforward and simple to understand of derivatives, so that many of them are vanilla swaps that are pretty easy for regulators and for participants in the market to understand. So in some ways it doesn't pose the risk that, you know, the credit default swaps during the crisis posed, for example. All that being said, you know, I agree with the general thrust, which is that we've seen that over-the-counter derivatives can be dangerous, and following the spirit of financial reform from this Congress, we and our fellow regulators are working to put as big a share as possible of swaps on centrally cleared central counterparty type exchanges, and to increase the transparency so that the regulators and the public will have more information. So we are working in that direction. I agree with you. It's an important objective.
Does the size of this overall market somehow give a false impression for the true demand for debt, and thus a false impression for the true interest rates?
Well, interest rate swaps are basically ways in which participants can convert, for example, a fixed interest payment into a interest payment which is floating and depends on some indicator. So it's really a way of just customizing the flow of interest received or interest paid. You can have enormous amounts of interest rate swaps based on a relatively modest amount of underlying debt. So I don't think it overstates the amount of actual debt in the market. It's really a hedging tool for market participants who want to customize the flow of their payments and receipts and interest rates.
Does the size of the market and the risks that some of the larger financial institutions, because I think that mostly just large financial institutions play in this market, and given the losses that they could incur given rapid swings in interest rates, does that somehow impair your ability to perform your job? Does it impair your ability to exercise independence in monetary policy?
No, I don't think it does, because the underlying instruments, credit instruments, are still the same. This is just a way of sharing the risk of, or the pattern of interest receipts and payments. I should have said that to the extent that interest rate swaps are not traded on central counterparties, we're also working, if they're traded over the counter, the regulators are also working to make sure that there is sufficient margin posted on both sides of the swap, so that if there are rapid changes in the value of the swaps, that both parties will be protected. And also, in fact, this afternoon we're going to have a meeting open meeting at the Federal Reserve to discuss Basel III, which will, and our discussion will include capital requirements for the market book, including derivatives. So in other words, even over-the-counter financial institutions are going to be protected both by the capital that they hold and by the margin that they place when they transact with counterparties. So it's important for us to take steps to make sure that individual banks are not exposed unduly to large swings in interest rates, for example. The counter example is AIG, which was basically taking a huge one-way bet, and when it lost the bet, it lost, enormous amounts of money, which nearly brought down the company. So we want to avoid a situation like that, and that means as much central counterparty trading as possible and adequate capital and margin for over-the-counter transactions.
Thank you, Mr. Chairman.
Thank you very much. Senator Klobuchar.
Thank you very much. Thank you, Mr. Chairman, for